Welcome to Invest Week, a digital series brought to you by the Australian Investment Council. Today's discussion looks at the returns that can be generated from investing into private capital, featuring insights from Eugene Snyman and Margaret Schlott of Cambridge Associates. The session covers diversified investment strategies and the role private capital plays within a diversified portfolio, looking at considerations for investing in private capital, impacts and drivers in private capital post-COVID-19, and some of the distinctions within private investment strategies.
Okay, well, welcome, and we're here this morning to talk a little bit more about our journey into the universe of private capital investing. Welcome, Eugene, and welcome via Skype to Margaret. Thanks, Margaret, for joining us. Thank you both for joining us today. Eugene, can you tell me a little bit about Cambridge Associates, about the work that you do and the advisory role that you play in a private capital industry context?
Sure, happy to do so, Yasser. So Cambridge Associates is a firm that was founded some 47 years ago, essentially starting to work with US endowments, very long-term investors, and advising across all asset classes, both listed as well as unlisted. Back in the late 1970s, private equity, venture capital, and other unlisted asset classes weren't that popular, but they've grown over the last 40 years that we've been advising clients to the point where we now advise clients that have over $200 billion invested in private capital in the US, Europe, Asia, as well as Australia and New Zealand. I myself have been focused on the private capital industry for the last 25 years, and that's the time that I've been at Cambridge Associates advising clients to build their allocations to private capital, and we've seen the benefit of that.
So tell me a little bit about a diversified investment strategy, Eugene. What is it? What is a diversified strategy, and what are the constituent components of adopting a strategy from an investment viewpoint that ensures you've got risk and reward allocated across a number of different segments and sectors across the economy?
Yeah, sure. So originally, portfolios really consisted of listed equities and fixed income, and there was a balanced approach. And you had your growth driver with equities that were quite volatile, and you had your defensive nature of fixed income, and you put those together in a portfolio, and that served you well.
Yeah.
But with volatility in equities, you realize that when they were zigging and you didn't have anything else that was zagging, there was an introduction of other investment strategies. Property would be one of those, infrastructure would be another, and then you add in private capital, private equity, venture capital. It's taken the growth drivers of equity investing, but putting it into a different structure and giving you access to opportunities that don't exist in the public listed space. Yeah. What that does when you put it together in a portfolio is it dampens your volatility, it creates better correlations, and it prevents the zigging and zagging of a chunk of your portfolio moving in one direction. So by bringing alternatives, private capital, other asset classes into a diversified portfolio, you are able to compound your returns better, minimize your volatility on the downside. And we've seen large investors move from a 70% listed equities portfolio to now having about 80% in equities, but well diversified across different strategies to help with that return driver, but then dampening on the volatility side. Yeah,
and whilst of course any strategy is not free from risk, and any strategy is no safeguard against that volatility, having a spread of strategy across different asset classes, but also a combination of liquid versus illiquid strategies is really important, isn't it? What is a distinction between the liquid versus illiquid strategies, Eugene?
Yeah, so liquid strategies are priced on a daily basis. So you will have volatility. If markets are up, you're going to be happy that day. If markets are down, you're not going to be happy that evening. Unlisted private capital doesn't have that mark to market on a daily basis. They typically are looking at valuations on a quarterly basis. So you dampen the volatility by not having that daily pricing. That's one of the benefits of not only property, but infrastructure, but also private capital, be that private equity, venture capital, and other types of assets. So you are able to, again, drive better returns, taking a medium to longer term outlook as opposed to very short term moves that listed equities provide.
Yeah, we're going to talk some more shortly about the short-term versus the long-term horizons in an asset class like this. But what I think is really important is to understand the role that a private equity and a venture strategy might play, Eugene, in a diversified approach to investing. Can you explain a little bit more about how you see private capital fitting into that mix? Clearly, there are different characteristics that exist between private capital and other forms of investment. You've highlighted already some of those broad themes as part of your reflections on a diversified strategy. But exactly what does a private capital investment strategy deliver to you as part of that diversified approach?
Yeah, so private capital is allowing investors, general partners is what they're typically called, to be able to raise capital and go and look for investment opportunities where they are not only putting capital in, but they bring in value add. They bring in more than just capital to the table. And it's that active management that we've seen that has been able to produce extra returns, what we refer to as alpha,
Right.
over and above what you can get in the public market space. And why is that? They are able to work on a medium to longer term strategy. Outside of the glare of a public market where there's quarterly reporting on the state of the business, they can focus on using the new capital that's come in to shift themselves into new markets, into new channels. They may invest more heavily in the business to be able to increase their expansion of their product. And so private capital really empowers the owners of businesses, private businesses, to be able to ratchet up the growth of those opportunities. And so when you bring that private capital opportunity into a portfolio, you are being exposed to different drivers of returns. And so you are typically investing into faster growing businesses that aren't on the listed exchange. Oftentimes they're innovative businesses, so fast growing, needing capital, burning that capital, but they need that capital to be able to continue to grow. Those opportunities add, as I mentioned, diversification to your portfolio, they add return enhancement to your portfolio, and they really are the engine for growth within your overall portfolio.
Which is and that's very different, Eugene, to a listed strategy, isn't it? Where it is not an active management engagement with the underlying investments. It is much more passive. That is, in essence, one of the key distinctions between an active asset management strategy like private capital and, say, an alternative in listed equities.
Correct. So listed equities, there's active strategies, but the active decision there is how much do you put in which geography or which sector, and do you overweight or underweight companies within those benchmarks or those indices, but you're not actively engaged with the management of those businesses to be able to reposition those businesses. Whereas private capital, that's very much the toolkit that they bring around strategic advice, networks, opening up opportunities to be able to help the growth of the management teams of those businesses. So getting right down into the not running themselves, but empowering the management of those companies to be able to generate better returns.
It's one of the themes that Mark Richardson and I discussed in the first part of this series is the alignment of interest and the focus that private capital investors can bring to their portfolio companies at a board level. As you say, not stepping in and running the business, but certainly doing everything possible to support the CEO, the CFO, the leadership team of the business to be able to execute on those long-term growth plans.
Correct, absolutely. And these aren't just advisors or consultants that are coming in, giving the management direction how to run the business. They have invested in that business, and they've typically taken a significant minority stake and or a controlling stake in that business. And so they are well aligned with the owners of those businesses or the management teams of those businesses for favourable outcomes.
Yeah. I want to turn now, Eugene, to a bit of a peek inside large, sophisticated institutional investors and the approach they take to engaging in the development of an investment strategy and the execution of that strategy. Cambridge Associates is a global firm you guys partner with and support from an advisory viewpoint, a wide range of institutional investors, all very sophisticated, managing big buckets of money all over the world. And so I'm really interested to hear a little bit of that insight from you about how you've seen change play out over the last few years, and particularly in the last 12 months, even the last 6 months. Clearly the pandemic has had an effect on some strategies. But really interested in your observations here, Eugene, about the way in which institutional investors, who have, of course, big resource base, big budgets, They can bring on board advisors like Cambridge and others to support them in their decision-making frameworks. What have you observed over the past decade, and how might that translate to the way in which individual investors, you and I individually, and other people who might be thinking about the way in which we manage our asset base, what can we learn from those large, sophisticated institutional investors?
Yeah, so maybe the best way to answer that is to take a step back. Over the 40 years that we've been advising very large investors with regards to private capital, the initial first steps into an allocation was very, very low single-digit allocation to private equity or venture capital, 2 to 3% of a large portfolio.
Right.
Fast forward 40 years, and those investors have seen the benefit of the asset class to the point where they're now allocating 25 to 30% of their portfolio. So more than a quarter of their portfolio is going to private equity and venture capital. Yeah. And that takes time. It's taken 40 years for those clients to be able to get there, and we've seen that steady growth of that allocation. There's lessons that have been learned along the way. What we as a firm that researchers and advisors clients as far as investing into private capital is concerned is it is about manager selection. Right. There's 9,000 odd private equity managers in the world, and they've run multiple funds underneath them. So there is a very, very large smorgasbord of opportunities to choose from. Yeah. But if you don't get allocations to the best of breed managers, your returns may be suboptimal. The cost, the effort, the illiquidity involved in allocating to private capital may not reward you. So taking time and being patient and thoughtful around diligence and understanding the best managers to allocate capital to and continuing to support those managers is what's really driven the growth in the allocation of our clients. It's also driven the return enhancement from those portfolios, where they've generated anywhere between 500 and 1,000 basis points. So 5% to 10% better returns than what you've seen in public equities. Yeah. You compound that over 30, 40 years, and it is a massive, massive driver in those portfolios.
And when we talk about institutional investors in this context, Eugene, who are we talking about? We're really talking here about superannuation funds, pension funds. Who are the other classes of institutional investors that adopt these types of strategies? Yeah,
so outside of the super funds and pension funds that you've mentioned, endowments, large university endowments have been very, very strong supporters of private capital over the years. Yeah. Very large family offices that have got the institutional requirements or means around them to be able to build these large portfolios. That's really been the domain of the allocation to private capital up until about 5 years ago. It's a combination of the minimums that are required to invest into these funds. These funds typically have a 10-year life, so you need to have an investment horizon that's long-term, and it takes time to have that capital be built up and invested. But as I say, in the last 5 years, we've seen a lot of innovation within the asset class that's opening the opportunity set to individuals to be able to gain access to private capital, bring it into their portfolios in the way that they weren't really even able to consider as recently as 5 years ago. Yeah.
Tell me a little bit about that innovation. So what are the changes that you can observe in your career so far in the way in which private capital has not only gone about its business activity of investing in an active way into those portfolio companies, but also that innovation in the way in which investors can access those opportunities? Let's hear a little bit about that from your perspective, Eugene.
Yeah, so what you really had previously was a need to identify a fund manager, a private capital fund manager that was raising a pool of capital at that point in time and make a commitment to that fund. Right. And that would be drawn down over time, which meant you had what was called a J-curve effect. So you would be paying fees on capital that hadn't yet been invested. Right. You knew it was about a 5-year investment period. And so the first 2 to 3 years, you were not getting much in the way of a return, but the return came at the back end once value had been created in those underlying companies, and then they were being realized and sold. So that in itself was more, you needed patient capital, you needed institutional investors to be focused on that. There's been a lot of innovation that's allowed private capital managers to offer co-investment opportunities to their investors to say, look, you're not only in our fund, but we invest in a company that's going to require more capital than what we are able to invest from our fund. Can you put capital in alongside? That allows you to put money in much quicker, build your allocation much quicker, but you're really leveraging and going off the coattails of a general partner that's identified good investment opportunities. That innovation has now stepped over to fund managers that are saying, look, we will actually, you won't commit capital and draw it down over time. You can put your money in from day one. You'll get a equity exposure from day one. It could be listed equity, more of a passive exposure, but we will then draw that capital down on your behalf into the investments as and when they occur. That could include co-investments. It could include what's called secondaries investing. It allows your capital to be invested much quicker. It shortens that liquidity challenge for individual investors. And that innovation has allowed this asset class to shift from the domain of solely being large institutional investors to now being available to individuals to be able to consider these opportunities.
Right. You mentioned something there, Eugene, about the challenge of illiquidity. And I wouldn't mind exploring this theme a little bit further with you because, it is one of the distinctions, isn't it, between a private capital strategy and other forms of unlisted asset strategies as against, say, public markets or a cash strategy. What does illiquidity in this context actually mean? Because you touched a few moments ago on the need to prepare yourself for a long-term approach to investing in this part of the market. What does that look like? What does an investor need to know about the differences between a private capital strategy and other forms of investment? And what does illiquidity mean in this context?
Yeah. So in terms of liquid asset classes like listed equities, you as an individual, so you can buy shares today, you can hold them for a week, and you can sell them.
Down.
And you may have a nice gain and say, I've done well.
Yeah.
Or you may get scared and withdraw and say, well, that wasn't for me. But you can do that on a day-to-day basis.
Right.
Pure liquidity is available for you there.
Yeah.
In the private capital space, that doesn't exist.
Yeah.
So you have to understand that your capital is going to be much more patient. It's going to take time to invest. So typically a private equity manager is going to have a 3-year investment period, 3 to 5 years, but typically it's invested within 3 years.
Yeah.
This means that they've raised a war chest of capital that allows them to go and look at private opportunities that are negotiated across the table in terms of a private business that they want to invest into. They will make that investment and draw your capital down, but they will take time to add value to that business. So typically for the first 12 months, you can have no real value add or uplift.
Yeah.
After 12 months, they're going to revalue that business. And then you can have a paper uplift as far as a potential return.
Yeah.
But what we find is, having made an initial investment into a portfolio company, after 2 to 3 years, that company is now grown to the point where it can now be sold. On-sold to another larger investor.
Right.
It could be listed. So there's opportunities to take capital off the table at that point in time when that investment has been sold, and that then returns to you as the investor. So you've got to be understanding that any capital you put into private market investing, you don't have control of when that liquidity is going to come back to you. There are guidelines and indications of what that would look like. But what we've found is typically it is a 5 to 7 year period before you are getting 100% of your capital back and the upside. But we've seen that you can get 2.5 to 3.5 times your capital back within that time period. And so that's what attracts investors in. But you can't change your mind once you are in the product and you've made that investment. So you've got to manage your liquidity as an investor. Yeah. That's why large institutional investors that have liquidity advantages, some of the endowments have their portfolios will be around through perpetuity. Yeah. So they think in decades and 50 years and 100 years.
Which is very different.
Very, very different to individuals. So they can take on that illiquidity risk.
Right.
There's a premium you want from a return for that illiquidity. And it is generally an expensive asset class to invest into. Yeah. But if you can get comfortable with those opportunities and you can see the returns that can be derived from investing in private capital, it does well reward you. And we've seen that, and that's why individuals are more interested in this particular asset class.
And we're going to hear from Margaret shortly about some of that outperformance, what that looks like, and the trade-off, the reward you get for accepting and buying into that long hold strategy and the liquidity that comes with it.
Correct.
Just one final piece, Eugene, around the makeup of the Australian ecosystem insofar as private capital is concerned. Again, drawing upon your multi-decades of experience in this space, clearly you've seen big changes here in Australia over that time. What do those changes tell you about the opportunity for investors to access this asset class and the opportunity for growth for an asset class like private capital here in the Australian economy?
Yeah, so over the last 20 years that we've been observing the local market, we've seen a maturing of the private capital space. We've seen very attractive institutional funds being raised to invest into the local market. They've targeted typically the small, medium enterprise, privately owned, oftentimes family-owned businesses, where they've been able to inject capital, bring institutional processes, and generate very, very strong returns. And we've seen that the local private equity industries shown its ability to generate very strong returns. We've also evidenced within the private equity space not only a focus on buyout investing, which really did dominate the local landscape for the last 20 years and still is very, very vibrant today. But we've also seen growth equity become more relevant, where private equity managers are buying a minority stake in a business but having influential outcomes around that business. And that has opened opportunities where individuals or families that own businesses don't want to sell out of the business entirely. They want to remain there, but they want to grow that cake to be bigger. Yeah. And that's created a tremendous opportunity for growth equity investing. But then venture capital has also been a fascinating opportunity in the Australian marketplace. We saw in the early 2000s, around the dot-com era, that venture capital was vibrant in Australia. But similar to the rest of the world, there were some challenged business models around dot-com investing. Yeah. That's changed. In the last 5 to 7 years, we've seen some very, very good, interesting venture capital managers raising capital locally, investing into local technology businesses. Absolutely. That are meeting a global demand. And we've seen in the last 5 years some phenomenal businesses founded, some multi-billion-dollar valuations on those businesses. And that's attracted the attention of offshore venture capital fund managers to come and invest into later rounds of those local businesses. And so Australia now is punching well above its weight as far as private equity buyouts investing, growth equity investing, as well as venture capital investing. Yeah,
something that I touched on in our previous instalment of this series with Mark Richardson was actually this point, Eugene, that you make about buyouts versus growth and expansion capital. Because buyouts tend to attract a lot of media attention. They tend to be on the front page of newspapers, particularly when they involve really large, iconic brand names. And we do certainly see here in Australia a number of those types of transactions happen on an annual basis. But in actual fact, when you look at the data, most of the activity here in the Australian market doesn't make the front page of newspapers, doesn't make the 6 p.m. news bulletins, but they are private capital investment transactions that occur in that mid-market zone, the SME sector as we generally think about it here in Australia. That's consistent with the evidence that you see as well.
100%, yes. The vast majority of capital is flowing into high growth opportunities, value creation for the economy, job creation, and it's all about growing the size of the cake. And so bringing fresh capital in to help businesses to expand their balance sheet, to be able to expand into new markets and new opportunities means they need to hire more staff and have more factories and more outputs for their product. It also opens up international channels for them. And so we've seen the benefits in terms of the local economy, job creation. And like you say, that's not necessarily in the broadsheets that we read on a daily basis. This is under the hood, talking to the private capital managers and seeing that firsthand in terms of the value creation and the job creation that those investments that they made have created.
And the innovation story here in Australia is a particularly remarkable one. I think your observations are absolutely consistent with the evidence that we see on the ground now, which is that Australia's capacity to deliver world-leading innovation, not just in our domestic market, not even just in our Asia regional market, but globally, is really coming to the fore now. And it's an opportunity that presents for Australia that is really compelling, and it's really exciting, isn't it? Because it has the potential to deliver to Australia that wave of economic growth, to create new industry sectors that don't even exist today out of our innovation potential, is a truly remarkable thing. And it's something where we're all working really hard to harness, I think, Eugene.
Correct. Australia's a beautiful place, and there's no surprise why a lot of entrepreneurs are choosing to either be homegrown entrepreneurs or foreign entrepreneurs coming to Australia, and realizing the world is a smaller place.
Yeah.
With COVID, it's become even smaller. Technology has allowed us to remain connected with the world, but you can live in a beautiful part of the world like Australia and run global businesses from day one. Because you can plug into the opportunity set, and technology is allowing that. And the venture capital investors are getting into the mindset of entrepreneurs very early on and saying, don't solve a local problem, don't solve a domestic problem, always have your mind on a global opportunity set. Our population is relatively small, but if we are able to use innovation and technology to solve a global phenomenon from Australia, we've seen businesses do that, and we've seen the uptake be tremendously positive. Fantastic for value creation, fantastic for job opportunities. And Australia is punching well above its weight. And as I mentioned, the top US and European and Asian-based venture capital investors are all very interested in the opportunities that have been uncovered in Australia, because they know these are innovative businesses, strong management teams, educated entrepreneurs that are wanting, that are hungry and are wanting to show what can be developed, innovated within Australia, and we've got great success stories that are already built. They're well baked, and I think in the next few years we're going to have some brand name businesses become globally well known that were founded in Australia.
Just one final question around the innovation ecosystem, because it is a fascinating opportunity here for us in Australia, I think, and of course to position Australian businesses globally, as you say. Tell me a little bit about the conversations that happen with institutional investors around the way in which they might look at the opportunity to invest into one of the sub-strategies underneath private capital, which is venture, which clearly is mostly directed towards investing in those earlier stage businesses, accepting that there's a level of risk that comes with investing in that part of the market, but the opportunities are there. And what I'm really interested in, Eugene, is there's often been a conversation about the exposure and the risk that exists for larger listed players on our equities markets, let's call them the incumbents out there, and the potential for these smaller early stage startup businesses to disrupt those incumbents. How does a venture strategy fit in that context? Is there some sort of approach here which involves using venture as in effect a hedge against the potential disruption that could play out in the listed equities market? If I'm an investor and I have a big exposure to listed equities, maybe this is a very smart way for me to manage the potential downsides that might exist for those incumbent players. Is that a fair way to look at venture through one lens at least?
Yeah, it's definitely a fair way. As I mentioned, private capital is a growth engine within portfolios, and most clients of ours are looking to generate that 5 to 6% return over and above inflation. And with high valuations within listed space and very, very low yields on the fixed income space, it's hard to make those numbers work unless you are bringing private capital into your portfolio. And venture is a boost of that engine when executed well, and we've been able to see the returns and the results from that. So that it's a return driver that draws investors in, but it is the innovation and gaining access to those opportunities, because they can be disruptive to your listed space. We know that more companies are going to go and eat the lunch of well-established businesses if they haven't been able to remain nimble, and they've got a little lazy as far as being large dominant players within their sphere. And we've seen that locally here as well as globally. And if you think about in the last 15 years, what has driven some of the biggest growth in the US around NASDAQ has been the companies like the Amazons, the Netflixes, the Facebooks, the Googles of the world. Those were all venture-backed businesses. At one point in time, they were a thought, a concept. They were loss-making, and it was venture capital investors that got those businesses up and running. And now they're the largest businesses in the world.
That's right.
So it's gaining access to those opportunities early on, to be able to have a counter within a diversified portfolio to businesses that may be challenged by those new incumbents, but also opportunities that we just don't even know exist.
Yeah.
There'll be jobs created tomorrow and in years to come from venture managers that we just don't even know we can't even conceive what they're going to look like.
Yeah.
And so it's part of that innovation. The other thing that we do a lot with our clients is think about ESG, environmental, social, and governance aspects. And innovation is core within those elements as well. And responsible investments, even impact investing.
Yeah.
Innovation allows an opportunity set for investors to be able to allocate capital within their portfolio to tick a lot of those boxes that don't yet fully exist within your public listed equity space. Those are more negative screens that allow ESG factors to be implemented into portfolios, whereas within venture capital you can be quite more directive around exposure to some of these new innovative ESG compliant growth opportunities.
Right. Well, I'm going to turn now to Margaret, who's joining us via Skype. Thanks so much, Margaret, for being a part of this conversation today. I want to turn to you a little bit more about a deep dive into the performance. Eugene talked a little bit about the potential for an asset class like private capital to deliver outperformance. But interested in your insights here about how that outperformance is delivered and what does that picture look like here in the Australian market?
Yeah, thank you, Yasser. One of the things I want to start with in talking about performance of Australian private equity and venture capital is to say that, it's delivered really solid performance over time. But what does that mean? Well, if we step back a little bit, we publish a benchmark and index on Australian private equity and venture capital, and that represents today 108 funds in the universe. What do those 108 funds represent? It's about 75% private equity funds and 25% venture capital funds. It represents data from 1997 through to present, so over 20 years of data. And I think when we step back and think about it, and what we can say about this industry here locally is that it is established. There are GPs within this industry that are very experienced. And what we've seen from a performance result is really solid returns over time. Now, Eugene talked a little bit about the importance of time frame and that these returns aren't seen on necessarily a quarterly basis. In fact, when we think about private equity and venture capital, we're really focused on the longer term returns. So 5 years, 10 years, 15, 20 years. And from that entire universe of 108 funds, we've seen over 10% returns in all of those periods, 5,
Wow.
10, 15, and 20 years. But what are we measuring? This is a pooled internal rate of return that we're looking at. And what does that mean? We're taking the cash flows of all those underlying funds and managers, and we're aggregating them up so it's verified data. And the other key point to consider here is that it's net of fees, expenses, and carried interest. I think we mentioned before that this can be quite an expensive asset class to invest in. So when we're evaluating the performance of this asset class, we think it's really important to strip out some of those fees, all of the fees, and then evaluate the performance. So really strong performance from that overall universe over time. Now, that's in and of itself, but what else can we do to measure that, or how else do we think about it? It's often coming from, we're pulling out of our listed equities investments to invest into these private sectors. And so, are we doing better than being invested in public equities by investing into these private equity and venture capital fund managers? And in order to measure that, what we look at is what we call a public market equivalent. It's not going to be the typical headline return that you see for the ASX 300. Instead, we want to take an apples to apples comparison. As I mentioned before, we're looking at an internal rate of return for investments in this segment. And so what we've done is done a cash flow weighted return of the listed public equity ASX and measured that versus private equity and venture capital funds. And what we've seen over time for that entire universe of funds is that on 5, 10, 15 and 20-year basis, private equity and venture capital fund managers have outperformed the ASX 300 by 300 to 500 basis points.
Wow.
And that's, as Eugene mentioned before, that's sort of a hurdle that at a start, because the asset class is illiquid, investors are looking for an extra compensation of return. And we can see that it's been achieved over time from this broad universe.
And so, Margaret, what role does ensuring that you target and select the best performing managers play in delivering that outperformance? Can you throw a dart and hit any manager and expect to realise those sorts of returns, or do you have to be very selective in this context?
Yeah, manager selection is important. So this is 108 funds that we're looking at of returns, and it's aggregated together to be a pooled return. But really, realistically, we can't buy the index here in this particular segment. You invest individually into the funds and into the managers, right? And so that manager selection is very important. I referenced the broad universe returns as being over 10% over time across periods. One way that we like to think about how do you measure that manager selection does matter? We can quartile the underlying funds. And if we take the top 2 quartile performers of those 108 funds, we get 52 funds that are in the top 2 quartiles over time. Right. And we measure their returns, and we see a significant uplift in performance versus that broad universe. So we're looking at 16, 17, 18% plus returns over 5-year, 10-year, 15 and 20-year periods. So that's an annualized internal rate of return, but it's net of fees, expenses, and carried interest. And what that looks like is very strong outperformance, 800 to 1,500 basis points, so 8 to 15% over the ASX 300 and the ASX Small Ords. Another way to think about it is when we have that universe of investments, the 108 funds, if we think about the top quartile investors and then funds and the bottom quartile funds, there's almost a 20% differential in the returns between those funds. And if we take the top 5% of funds and the bottom 5% of funds in that big broad universe, there's nearly a 60% differential in returns. So manager selection does matter. And when we think about it, Eugene touched on some of these practical implications. It's an illiquid asset class. You can't buy and sell in and out of it. So you want to do the work up front to determine that you're investing in a manager that has an experienced track record. And we've seen persistence in performance of managers, individual funds over time. Those that have succeeded tend to continue to succeed in future funds.
Right. So it really does paint a picture here, Margaret, that doing your homework, understanding exactly the profile of managers that you might be looking to invest into is absolutely critical, because as you quite rightly say, there is no opportunity in a private capital context to do something like you might be able to do in a listed market context, for example, invest in an ETF. You can't do that in private capital. And so paying very close attention to the track record, the performance, the experience set, the underlying experience of individual managers will serve you well based on the data and the analysis that Cambridge has put together over the last 20 plus years.
That's right, yes.
Margaret, one of the other really interesting themes that emerges in a private capital context is the similarities and the distinctions that can be drawn between the types of sector exposures that private capital managers might invest their capital into versus, say, the public markets. I know Cambridge has some really interesting data here that does a comparison and contrast between those two themes. Share with us a little bit about that. What are the differences, and what do you access when you invest into private capital beyond the returns, which of course we know are significantly compelling based on the insights that you and Eugene have shared already. But what else do you access when you're looking to increase an exposure into the private capital asset class?
Yeah, that's right. The returns are significant and really a role within the portfolio. But in addition to just the returns that we're getting, we get different types of exposures, from this segment of our portfolio, and that's really important. So one of the ways that we break it down and think about it is, when we're thinking about this general universe of investments, the broad market of private equity and venture capital investments that occur within Australia, is the sector exposures of the underlying companies that these funds invest into. And so what we can do is take the company level data that we have and break that out by sector. And we can look at where have over time all of the invested capital dollars gone across different sectors. But what does that look like versus the ASX 300? And what we've seen from private equity and venture capital in Australia is that over time, 90% of invested capital has gone into a consumer, healthcare, industrials, media and telecom, and IT investments. When we think about what exposures we get from the ASX 300, that's very different from the public index, which is dominated by financials and materials. Another useful component to thinking about this is to step back and say, okay, well, that's over time. That's where 90% of the dollars have gone in. But where are we today, and what does that look like? And if we look at the current net asset value of investments from private equity and venture capital funds, we also see there's a very strong exposure in those asset classes that I've mentioned. So consumer, the healthcare, industrials, IT, and the media and telecom and entertainment. So in addition to the actual sector diversification that we get from private equity and venture capital company investments, another factor that's quite different from our public market equity exposure is the size of the companies that we're investing in. So the size of the companies in that broad market ASX 300 are much larger than what we see in terms of the size and the access to return profiles and economic drivers of companies that are in the private equity and venture capital investments.
So Eugene, clearly the pandemic has had a pretty significant impact on economies all over the world, on markets as well as part of that. In a private capital context, what are your observations about the impact of the pandemic? Will there be profound impacts in our sector, or do you think the landscape and the universe for private capital will be largely undisrupted by what's happened?
It's hard to have a crystal ball to be able to gaze forward and know what the impact of a pandemic will have on not only private capital, but most asset classes. What we can do is look back and see what other market dislocations, events have occurred and what impact that's had on private capital and portfolios in general. And there's two that really stand out. The one is the dot-com era, the tech wreck, 99-2000. We saw the largest sector in the US take a very, very hard hit. And that had a significant impact on investment portfolios. But subsequent to that, we saw private capital provide very, very good, strong returns in the years that followed. And that was really companies and industries that were challenged and needed fresh capital to be able to rebuild themselves. The same occurred in the GFC. So 2008, 2009, the financial crisis that occurred. Most industries were impacted, but financial services in particular, banks and insurance companies were hard hit. That had a flow-on effect, and we saw some distressed investing opportunities that private capital were able to pivot towards. And then more traditional private equity investing that occurred in the subsequent years in 2010, 11 and 12 happened to be the best returns by vintage year. And by vintage year, we mean those years of capital that was put to work. Right. The best returns that have been generated from
that's because there are businesses out there in the economy that haven't been able to weather the storm, as it were, as well as others perhaps. And so there's been a real opportunity to bring capital to work to support those businesses, to ensure that they're stabilised and then reposition them for a new wave of growth.
100% correct. The other is the challenged traditional sources of funding were more blocked. Banks weren't really able to lend to those private businesses in the way that they did prior to the GFC. And so private companies that hadn't really considered private capital as investment opportunities for those businesses turned to that subset. So the opportunity was broad and deep, and we saw the capital and the value add from the private equity and venture capital managers come through as far as those strong returns. So when we look forward, we've obviously had a market dislocation locally, globally. Industries have been shut down. We don't quite know when they're going to fully open. When they do open and the government stimulus and support is withdrawn, there will be pain. There will be challenged industries and businesses that are trying to navigate through a recessionary period. Private capital is well positioned to be able to provide investment impetus into those businesses, allow them to be able to survive and reposition, and then expand into a economy that will recover at the back end of the pandemic. So once we get to the other side of the valley, those businesses that have been funded, that are in the hands of private capital, we think will be able to thrive. So we think the next 12 to 36 months will be very, very good investment opportunities for private capital. They are able to be patient investors. They will identify industries that will have shoots of growth coming through, and will be able to invest in those businesses arguably on better valuations, but bring that value add, that toolkit that I mentioned earlier, to be able to add value to those businesses and create value for the businesses as well as for the investors in those asset classes.
Yeah. I want to turn now, perhaps one of our final themes for today's discussion, Eugene, to private credit. We often talk about private credit being one of the sub-strategies, much like private equity, venture, infrastructure, real property, as another one of those sub-strategies underneath this broad umbrella of private credit. But what are the distinctions when it comes to credit as against, say, private equity and venture? What are the key areas of difference between those sub-strategies that investors should be alive to?
Yeah, so most of our discussion has been around the growth engine with regards to equity and private capital equity opportunities. We can't ignore the defensive part of a portfolio, which traditionally has been fixed income and cash.
Yeah.
And you used to be able to get 3 to 4% from your fixed income without taking much in the way of risk.
Yeah.
Very low volatility, and that was very nice to be able to have that compound.
Yeah.
But as we've seen in the last 10 years, interest rates have fallen. We felt that they'd fallen to the lowest level they could fall, and then they've fallen even further.
They fell a bit further.
They've continued to fall. So running yields
Yeah.
now are anywhere between negative to half a basis point.
Yeah.
And so if you're getting 50% return, 0.5% return on a portion of your portfolio, that is a big, big headwind that one has to uncover.
Yeah.
You can either shift capital up into the growth equity portion of your portfolio and minimize your defensive fixed income allocation, or you can look at opportunities within that broad category. And that's where private credit is very interesting. It's defensive in nature, and it's got characteristics that are very attractive. So private credit is really private managers that are investing on the credit side of a business, much higher in that capital structure. And most of what we've seen locally as well as globally has been the opportunity to provide senior secured lending. What does that mean? It means that you are providing a loan to a business, but it's secured on assets or cash flow of that business, and it's senior in that capital structure. So you're not taking risk. You really are focused on the health of that business, their ability to be able to repay the interest on that loan, and that loan in its entirety at the point when it is required. The returns that these private credit managers are underwriting those loans to are anywhere between 5 and 7% a year.
Right.
So if you think about a 5 to 7% return relative to a 0.5% return, it is very attractive.
That's a big difference.
Again, it's illiquid.
Yeah.
So you can't just trade in and out.
Yeah.
You have to be a little bit more patient. Most of the private credit funds will have a 12 to 36 month lock, because they need to provide that loan. That business needs to draw that loan down and then repay that loan.
Right.
But these are also floating rate loans.
Yeah.
So the risk to fixed income is if we have rate rises, we don't think we're going to have those for a
Yeah,
while. We
for
think
a
it's
while.
going to be lower for longer.
That's right.
But at some point in time, we'll have inflation and interest rates start to turn.
Yeah.
That'll be negative for your fixed income portion of the portfolio, but the private credit will ratchet up. And so if interest rates rise, so the loan repayment from those businesses will also rise. So you're protected as an investor in that space. The other aspect is locally we've seen banks pull back from their ability to lend into the private market space. Historically, they used to be able to be the sole funder of those opportunities, but with the regulator focused on the bank's capital loan ratio requirements and ensuring that they are going to be stable and be able to weather any future setbacks. It's harder for the banks to be able to provide those loans to businesses without quite a few requirements and regulations around those loans to the businesses. And so that's created an opportunity set for private capital funds to be raised that can go in and provide a source of funding to businesses that don't want to raise equity. They want to raise credit. They want to have it for a shorter time period just to be able to see them through. And they are willing to pay a higher interest rate for that because there's more flexibility for that business to be able to repay that loan sooner if they choose to. And private credit is much more nimble. We were talking about innovation earlier. There's been a lot of innovation that's occurred within the private capital space. If one looks overseas, 90% of the loans to the private businesses in the US, 90% of that is provided by non-bank lenders.
Wow.
In Europe, it's about 70%. Those are mature industries that have shown that growth. In Australia, it's still only about 5%.
And do you think Australia has the potential to reach those sorts of numbers over time?
Definitely. Australia is very similar makeup to our local market, to the developed markets of the US and Europe. And so we think that maturing in the local industry, it's still relatively early days. But the amount of capital that's been raised in the private capital space, seeking those opportunities, it's becoming more and more readily available. It's been more accepted by private businesses that they can look at alternative sources of credit to be able to fund their businesses. So we think that there's upside here as far as that market expansion. The four banks, main banks, as I say, have limitations in terms of how much they can lend. And so it's almost a loan out as a new loan in on their book. And so they can't really expand that book of business necessarily. That's creating a tremendous opportunity for private credit managers, not only in the Australian market, we've seen it in the New Zealand market, we've seen it in Asia. At the same time, private credit is expanding across the entire Asian region, and we think that it's going to mirror what we see in the US and Europe in years to come.
Eugene Snyman from Cambridge Associates, Margaret Schlott joining us via Skype from Cambridge Associates. Thank you both so much for being a part of today's conversation. It's been fascinating to hear a little bit more about the returns profile, the data that underpins the compelling proposition of investing into an asset class like private capital. Thank you both for joining me, and we look forward to continuing the conversation in the period ahead.
Thank you, Yasser.
Thank you, Yasser.